Well, hi, everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
It's me. Hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. Well, hi, everybody, and welcome to the Saturday Stock Analysis Video Podcast. And we're going over retail companies today. And Amazon is our first company. It's also known as an internet company, but folks, it sells retail. And Costco is next, and we just love Costco. And in the news all this week was Kroger. So let's take a look at these three companies together. Debbie, let's go over our first stock today.
Alrighty, JB, that would be AMZN.com, and they are one of the largest online retailers. The company opened its virtual doors in 1995.
I remember it well.
I know, it was like yesterday. And the sales breakdown is North America with 60% of sales, international sales 31% of total. Amazon Web Services, or AWS, is 9%. Third-party sellers, the marketplace, account for about 20% of sales. They acquired CD Now in 2002, Audible.com in 2008, Zappos in 2009, and Whole Foods Market in 2017. They have 230,800 employees.
Wow, it's a lot of people.
That's a few
it's
people.
A pretty big company for an online company, folks. So the first thing we want to look at is the clean surplus return on equity. And folks, to get into our growth portfolio, we want to see a clean surplus ROE of 20% or better. And this company is just knocking it out of the park. And that's because the 2019 net income has been adjusted upward by a huge amount, by about $6 or $7. And that is driving this clean surplus ROE way up. And look at the retention rate. The retention rate is 100% because it does not pay out dividends. And you folks know, especially the ones that have been with me for a while, that I would rather see a company pay no dividends because that means it's putting all the money back into itself in order to grow. Net income growth, way, way above average, and we'll go over the averages in a little bit. And revenue growth, way, way above average. Debt, almost no debt, so we don't even worry about debt. And this is years to pay debt. Now remember, the rule of thumb by Buffett himself is that if you take all the money that a company is making and using it to pay off debt, how many years would it take to pay off that debt? And the answer here is 2 years. His rule of thumb is 5 years or less. We like to see 3 years or less. So Amazon certainly fits that bill. And looking at the 1-year return, it's this mustard-colored line. It is slightly outperforming the S&P 500 this year. It had been doing very, very well, as you can see, but it's outperforming the S&P 500 by about 5 or 6 percentage points. And then over 5 years is where you really see it shine, up 350%, while the market is up 50%. That's 7 times more than the market, folks. So you can see it's done very, very well for itself. Okay, Debbie, let's get into our second retail store of the day.
Alrighty, next up is Costco Wholesale Corporation, and they were formed by the merger of Price Company and Costco Wholesale in October of '93. The company operates wholesale membership warehouses in the U.S., 527, Canada 100, Mexico 39, United Kingdom 28, Japan 26, Korea 15, Taiwan 13, Australia 10, Spain 2, Iceland 1, and France with 1.
I guess that you can call them international.
I guess they are. And they sell merchandise directly from warehouses to a restricted membership. Food and sundries account for 43% of sales, and they employ around 218,000 people.
They're about as big as Amazon.com in terms of number of people employed.
Well, they're all over the place.
Yeah.
They should be.
And looking at Costco and that clean surplus return on equity, and you can see it's above our threshold of 20%. And folks, it has been rising over the years. Very, very nice. And look at these dividends over here. We can see that it pays outsized dividends every 2 or 3 years or so. It just builds up this cash, has nothing to do with it, and so it gives it back to the shareholders, which corporations are supposed to do. So it's doing very, very well. Net income is almost above average, and revenue growth is about average. Years to pay debt, very, very little debt. So this is another good company that just has very, very little debt, and we don't have to worry about it getting itself into trouble during a recession. Plus, people are going to continue to go to Costco during a recession, maybe even more so, because that's where the lower price goods are, folks. And looking over the past year, this stock has done very, very well, with the market up about 3%. This stock is up about 26, 27%. Very nice. And over the past 5 years, it is up over 105%, almost 106, 7%, while the market is up about 50%. So, folks, it's doubling the market over the past 5 years. That's the kind of stock we like to see, especially with the safety built in. It's just making so much cash. It has no problem with its debt whatsoever. So not only is it a safe company to protect its dividend that it's paying, but it's also continuing to be a growth stock. The market just loves this stock. All right, Debbie, let's go over our final retail store of the day, and we've been hearing a lot about Kroger this week, and let's see the numbers on this as soon as we finish with the description.
Well, you said it. It's Kroger Company, the nation's largest grocery store operator by sales, with about 2,775 supermarkets, multi-department stores, and warehouse stores in the Midwest, South, and West. Number 1 or number 2 share in 46 of its 51 major markets. They also operate 274 fine jewelry stores. That I did not know.
Me neither. Wow.
And they sold convenience store
Stay
businesses.
away.
No, oh, okay. They sold convenience store business, 762 locations as of 4/18. Manufacture and process private label goods at 37 plants. They acquired Harris Teeter in 114. The average food store size is about 64,250 square feet.
Yeah, pretty big store.
It's big.
Yeah.
And they have about 449,000 employees, the majority covered by collective bargaining.
Yeah, now notice they have twice as many people as Costco or Amazon. And we'll see what the numbers tell us, because now they have to take their sales and divide it between twice as many people as Amazon and Costco. And looking at the clean surplus return on equity of Kroger, and folks, it just does not fill the bill. Plus, it's declining over the years. Remember, we looked at GE last week and it had a paltry clean surplus return on equity. Well, Kroger is right there alongside of it. And the retention rate is about 73%, so it means it still wants to grow in there. The key is, can it? And the thing that catches our eye right here is the years to pay debt. It's got a lot of debt, folks. So number one, we don't like the clean surplus return on equity, and therefore would look no further on this company because we don't want it in our portfolio. Years to pay debt, too much debt. And when we look at it over 1 year, we can see it was doing very, very well. And then it fell down to still above market returns. So it's been doing good for itself as far as people buying the stock, But as far as putting it in our growth portfolio, we would not touch this company. And looking at it over 5 years, with the market up about 50%, it's up about 13 or 14%. So it's lagging the market by a long shot. And when we look at these three stocks together, with Amazon leading the way with an ROE of 63% for 2019, or projected to be, and the net income is way above, about almost triple market averages. The revenue growth is more than triple, not about, more than triple the market averages. And then we get to Costco right here in the middle with a nice rising ROE, now above 20%. Net income growth is a little below average, and revenue growth is about average. So to me, this is a no-brainer, folks. This is a company that's just going to keep pumping out the cash. And you've all been to a Costco, so you understand what kind of store it is. And so we like this. It is in our growth portfolio as well as Amazon. And then we come over to poor Kroger over here. And I'm going to show you something in the next slide that's going to knock your socks off, folks. But Kroger has an ROE that's declining. That means it is still making money, but that earnings growth is slowing down. And the market does not like to see that, so you might get hurt putting money into this stock. Net income is below average, about half that of average. Revenue growth about half that as the market averages. So, folks, we don't see anything good about this company, even though I know a lot of you like to shop there. But no, it's not for us. And I want to show you something here that is really, really something. And of course, it's the wave of the future, is that you are a good company if you are returning more with less. And let's look at the total revenues of Amazon and look at the total revenues of Kroger. And you can see that the total revenue income, $225 billion with Amazon, is almost twice as much as Kroger. And then when you come over here to employees, Amazon is doing almost twice as much in sales and revenue as Kroger, and it's doing it with half the number of employees. And when we look at Costco, it is doing much better than Kroger as far as total revenues. And folks, it's doing it with half the number of employees. So you can see which way industries are going. And if we could do retail sales over the internet, people are getting more used to computers. In fact, we have several generations now that are being raised on computers and know nothing more than computers. Then that's where the sales are going to be in the future. So we see more and more future for Amazon, less and less for Kroger, even though Amazon and Kroger have a little deal going where you can return things to Amazon through a Kroger store. You go in, I want to return this, no questions asked. And that's the end of the story. So Amazon, rather than getting its own footprint out there, would rather go to a store like Kroger and say, look, you need the foot traffic. We'll drive foot traffic to you if you return our items for us. And those are the deals that are being made out there, folks. And I just wanted to point that out to you. And when we look at the returns, once more, over the past 12 months, we see Costco is leading the group here, and Amazon and Kroger are above the S&P 500. The S&P 500 is the black line, and you can see Amazon and Kroger are bunched together right here. And then when we go to 5 years, Amazon is leading the pack, 350% return, 7 times more than the S&P, which again is this black line. And Costco is number 2 at doubling the S&P over 5 years, and Kroger is lagging by quite a bit. Kroger almost didn't make any money over the past 5 years as far as stock appreciation goes. So, folks, we have Amazon in our growth portfolio, we have Costco in our growth portfolio, and no to Kroger.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, don't forget, if you want to receive a full free month of all our letters and complete access to our computer program, just go to our site, buffettandbeyond.com, and sign up. Remember, all you need to manage your own portfolio, and it's free. Hey, just go to buffettandbeyond.com, and remember, Buffett is spelled with 2 F's and 2 T's. That's buffettandbeyond.com. Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.